at every turn, the Fed has made it harder for foreign central banks to go and grab US dollars from US private markets. They have to go through the Fed. Do I think it's $80,000 or anything? No. But, let's start with 5 or 6 or 7.
What do you think?
Is it going to be 10? Is it going to be 12? Is it going to be 15? It could be 15,000. I don't know.
Gold investors have had plenty to celebrate. Whether driven by skepticism of fiat currency, concerns over economic instability, or broader financial motivations, gold has surged over 40% in the past year, more than doubling the S&P 500's gain. The precious metal recently hit a record high of $2,911 per ounce, fueled by domestic and global uncertainty, inflation fears, and shifting macroeconomic conditions. Meanwhile, speculation is mounting over the Trump administration's potential influence on the gold market, particularly after Treasury Secretary Scott Bessent stated that they plan to monetize assets on the U.S. balance sheet. But what exactly does that mean? And more importantly, how could it impact gold? Joining us is Tom Luongo, who argues that gold prices must be significantly higher than they are today. While he doesn't anticipate extreme levels like $80,000 per ounce, he suggests that gold could rise to $5,000 or even $15,000 in the future. Still, monetizing America's gold reserves highlights the delicate balance Bessent must navigate, managing the country's soaring deficit while advancing Trump's fiscal agenda. House Republicans are reportedly considering a tax and spending plan that would add $6.5 trillion to the federal debt, potentially doubling its growth according to the Committee for a Responsible Federal Budget. Meanwhile, interest payments on the national debt have surpassed spending on Medicare and defense. According to Luongo, those advocating for tariffs, a gold-backed monetary system, and similar policies often strongly support the dollar system. He argues that such measures are unnecessary since the U.S. already possesses valuable assets that should remain within the domestic economy, fueling wealth creation and investment rather than being sent abroad. Join us as we dive into the video for a deeper look. Don't forget to subscribe and click the bell icon to stay informed about our latest updates.
The people who are screaming about tariffs and they're screaming about, reintroducing gold to the monetary system and this, that, and everything else are all people who are, who are sycophants for the Eurodollar system. And maybe I'm wrong, but I don't see that's we don't need to do that. We have assets that should stay here and circulate here. And as we build wealth, we convert it into hard assets, which we then monetize and use to build, as savings. And then we take that pool of real savings and monetize it and turn it into investable assets that we then go build new, beautiful things with. Like, I don't know, rebuilding Philadelphia or rebuilding, pick a city. Let's start with one. And stop with this nonsense that, we shouldn't do that. And we should just send all the fruits of our labor overseas to the highest bidder. No, that's what the Fed should do. And the Fed has, and over the course of the last few years, if you look carefully, you'll see, do I think it's $80,000 or anything? No. But, let's start with 5 or 6 or 7.
What do you think?
Is it going to be 10? Is it going to be 12? Is it going to be 15? It could be 15,000. I don't know.
No entity officially holds more gold than the U.S. government, and a simple accounting adjustment could create a windfall of approximately $750 billion on the country's balance sheet. According to government financial statements, the U.S. owns about 261.6 million troy ounces, nearly 8,200 metric tons, of gold. These reserves are currently valued at an outdated fixed rate of $42.22 per ounce, a figure set in the early 1970s, giving them a book value of just $11 billion. However, at gold's current market price of around $2,920 per ounce, its true market value is close to $765 billion. Tom Luongo believes this valuation discrepancy highlights a critical issue. The U.S. financial system's gold-to-debt ratio is approximately 10-to-1 or 11-to-1, a level he considers inadequate to restore trust. Gold prices need to rise, or the Fed's balance sheet needs to shrink, he said. If the Fed reduced its balance sheet by half, lowering it to around $3.5 trillion, the ratio would improve to roughly 5.5-to-1. But the key question remains, Would that be enough to restore confidence in the system? Now, let's redirect our attention to a video.
Now we're talking about a two-tiered monetary system, so I guess that's off the table. But let's just use that framework, even though we've already established that maybe that's most likely not what's going to happen. We have a $7 trillion or $7 trillion balance sheet at the Fed now. We've got $700 billion worth of gold on the balance sheet, roughly. I don't know, maybe it's 750. I don't know. You can calculate it out at $2,900 an ounce, $3,000 an ounce. Let's call it roughly an 11 to 1, 10 to 1, 11 to 1 ratio. Is that enough to engender trust in the American financial system? No, clearly not. Gold price needs to rise, or size of the Fed's balance sheet needs to come down. What if the Fed cuts its balance sheet in half? Now it's a 5 to 1 ratio. It's 5.5 to 1 ratio. Is that enough to restore trust? I don't know. We're going to decide where trust is reestablished, right? When we say, okay, it's done. Maybe we see the Fed cut its balance sheet in half and the gold price rise from 2,900 to from that gold we have on reserves from $700 billion to $3.5 billion, $3.5 trillion, and the Fed with a $3.5 trillion balance sheet. Well, that'd get us to 15 grand, right? Because we'd have $3.5 trillion worth of gold on the Fed's balance sheet. The Fed would have no mortgage-backed securities, no treasuries, right? Plus, a couple of $1 trillion in notes in circulation or whatever. And roughly, it's like, roughly that's where we would be. And then we would have that. And then the liabilities of the Fed's balance sheet would be the notes in circulation, blah, blah, blah. Would that work for you? That's assuming we didn't buy any gold and put any more gold on the Fed's balance sheet. That's assuming a lot of ceteris paribus, all these, none of that is, it's not a complete argument. It's a model, but it gives you a framework with which to think about where you could be. We could also be looking at, a nominal GDP of real economic wealth generation, not what we currently have, which I think is about half of that. I think our nominal GDP is about twice or more of what I think our real GDP is. So what if we had a real GDP of $30 trillion as opposed to a fake one? Well, then we'd need a $6 trillion Fed's balance sheet and $30,000 gold. Again, assuming no Treasury asset-backed currency backed by a sovereign wealth fund. But we know they're putting a sovereign wealth fund together. And they know, now here's another one for you. They want to buy 1 million Bitcoins. Well, at $100,000 a piece, that ain't a lot of money. That's not an interesting amount of money until Bitcoin's $1 million a coin. Then it's $1 trillion. Now we're talking a sovereign wealth fund of a country that's building $30 trillion worth of wealth every year. That's a pool of real savings, along with gold, along with oil and gas revenues, along with. Now you're talking a real account. Now $4.5 trillion worth of Fannie and Freddie shares that they sell into the market. Because remember, those Fannie and Freddie shares were pulled off the market at $80 a share back during the global financial crisis. They're currently trading for about $6. Fannie and Freddie have real operational cash flow of $150 billion a year that they're making. So how much is Fannie and Freddie actually worth? Are they worth $80 a share? Or are they worth $800 a share?
The relationship between gold reserves and the Federal Reserve's balance sheet highlights a fundamental issue of trust in the financial system. The massive disparity between the book value and the market value of U.S. gold reserves suggests that the price of gold must rise significantly, or the Fed must drastically reduce its balance sheet to restore confidence. A simple accounting change could dramatically alter the perception of financial stability, but whether such a shift would be sufficient remains uncertain. The broader question is whether an economic system built on ever-expanding debt can regain credibility without significant structural changes. Should the U.S. reduce the size of the Fed's balance sheet, or is a higher gold price the real solution? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.